So how do corporations and small businesses use whole life insurance? Specifically for the cash value benefit. The first question that comes up often is, who does the life insurance go on? Because it can't go on the brick walls of the business. It has to go on an actual human being. I've got to have the life insurance policy on someone. So we'll discuss exactly that today. We're going to go through two quick examples. One, a smaller company. We'll discuss an owner who wants his company to own a policy. And then second, we'll discuss a corporation and exactly how they set up whole life insurance policies that are owned and controlled by the corporation. Let's begin with the small business owner. So how a small business owner can use a whole life insurance policy is it typically begins when one says, I've got a company, I own an LLC, and I want to take out a whole life insurance policy that is owned and controlled by the company. I want to do that because it's my preference, or my attorney recommended it, or maybe even my CPA did, but here's what I want to do. So my business is going to own the policy. The life insurance should be on me. So this is a situation where the owner of the company is placing life insurance on his life. The company owns the policy, therefore the company benefits from the policy. So what I mean when I say that the company benefits from the policy is this. The company funds the policy. They're making the premium and PUA payments. The company has access to the cash value. The cash value is an asset on the small business's balance sheet. They can take loans, they can repay them, they've got full access to the cash value. The death benefit, who's that on? That's on the small business owner. So if anything happens to the owner, that's when the life insurance death benefit is paid out. The insured, the owner in this example, needs to apply for a policy and go through underwriting in order to be approved. Now, because the company owns the policy in this situation, financials of the business do need to be disclosed as well. Now, the thing about a case like this, where you've got a small business owner that wants a policy that's owned by his company, the asset, the policy, is technically owned by the company, but if the owner owns the company, well, then he also owns the policy and can use it very similar to how he would use it if it was an individually owned policy. But a couple key points here. The company is the one making the premium and PUA payments. The company has access to the cash value and can use it for whatever the company wants. And the death benefit is on the insured, the owner. In cases like this, usually the company is the beneficiary, where we'll often see business owners set up a policy like this to have key man insurance as well. So for example, I've got a policy that is owned by a management LLC, where if anything happens to me, the death benefit is meant to be used as key man insurance. This way, the company is taken care of and it can continue to function. So the key man insurance piece is something that is important to me. However, the cash value is what's attractive. Therefore, I want to fund the policy and be able to use the cash value as a line of credit for my company, because that's where the fun is at least for me, because I am a nerd with this life insurance stuff. So how small businesses typically use life insurance is sometimes a business owner will set the policy up where the company owns it. A question that comes up frequently is, can I deduct the premium payments? And the answer is typically no. If I'm deducting my premium and especially PUA payments, what will likely happen is that the policy can be viewed as a qualified asset. So if it's viewed as a qualified asset would be similar to a 401k, where the value grows tax deferred, and anything I access, I've got to pay income tax on the gains, a potential 10% penalty tax if I touch it prior to age 59 and a half. It's no good. And if I am setting up a life insurance policy where I can deduct the premium and PUA payments, it typically has to be set up within a qualified plan. Sometimes that could be a 401k, maybe it's a self-directed IRA, and there's other plans called 412 and 419 plans. But that's a lot of additional information to answer the question, can I deduct my payments? And the answer typically is no. I should say it's no if you want to have access to the cash value free and clear as you could with an ordinary policy that you own, which most small business owners want that. They want to be able to access the cash value with the tax benefits, being able to do so tax-free, and not have to worry about a taxable event. So that's an example of how small business owners use cash value life insurance. Let's talk about corporations now. So how corporations typically use whole life insurance is like this. A corporation will take out a number of policies on their executives. This is often set up in the form of a non-qualified deferred compensation plan. Non-qualified because they're not deducting the payments. So let's say you own a corporation and I am one of your executives. Thank you for hiring me and giving me the executive role. So you've got me and 4 or 5 other people, and you say, okay, I want the corporation to take out policies on these 5 executives. Steve's one of them. The corporation is going to fund the policy. The corporation will own the policy. So the cash value is an asset on the corporation's balance sheet. The corporation has access to that cash value. The corporation is the beneficiary of the policies. So if anything happens to me or any of the other executives, the death benefit proceeds are paid back to the corporation that you own in this example, income tax-free. What do you think I'm going to say to you? Well, you're taking this policy out on me. It's great for the corporation and all, but what's in it for me? Often executives will feel like this. So what's in it for me is you, the corporation, say to me, Steve, if you stay with the company for the required vesting period, which is the next 10 years, or maybe it's until age 65, you can make the vesting period whatever you'd like. But if you stay with the corporation, Steve, until the end of that vesting period, we are going to pay you a retirement benefit. Say it's $50,000 per year, and that'll be from age 65 until the day you die. I say, okay, great. So I've got to meet the vesting period. What if I don't meet the vesting period though? Well, if I don't meet the vesting period, I do not get that retirement benefit. So what's the catch there? Well, I've got to stay with your company until I meet your vesting requirements. If I'm a top performer for your company and drive a lot of revenue and really help the company grow, am I going to leave? Or I should say, am I likely to leave the company? No, I'm likely to stay because I want that retirement benefit. I want that bonus package at the end of the vesting period. So you'll see a lot of corporations use cash value life insurance in exactly this manner. What they're doing is creating what we like to call golden handcuffs in the industry to retain their top talent and then reward them at the end of the road. Now, if the executive, if I said, hey, forget it, I'm out of here anyway, I've decided to start my own company, it's just really, really what I want to do. You, the corporation, keep that policy. It's still an asset on your balance sheet. Now, if you said, Steve doesn't work for us anymore, so we don't really want the policy on him, what do we do with this? Well, remember, you still have access to the cash value, but when you replace me, when another executive or employee comes in and you say, okay, this person's very good, they filled Steve's role, what you can do is actually transfer that policy that was on me, maybe it's 10 years old, you can transfer it to this new individual. The individual does have to go through underwriting. However, you're not starting all over with a new policy and going through the expenses again. You've got that same 10-year-old policy. It is repriced, but the values won't adjust that much. It's very advantageous for a corporation to be aware of this. You'll see this occur a lot with corporations. The first time I heard about it was many years ago with professional ball clubs that would do this. So sports teams would do this, which makes sense because they're trading players all the time. But it's something that's very, very nice to be aware of because I don't have to go through the negative years of a policy again. If I lose an executive or employee that I had this policy on, I could just transfer it to someone else. And here's the last piece. So let's assume that I stay with your company all the way through, and then you pay me a retirement benefit of however much you promised me. You're paying me that from the cash value buildup of the policy. This way, when I'm retired and no longer producing income or revenue for your company, you're not paying me from your profits. You're using the cash value buildup, the asset there, which is nice. When I eventually kick the bucket, these plans are typically set up where a death benefit is still intact. This way, the tax-free death benefit flows back to the company and helps recover those costs that you have spent along the way. So this is something that has gone on for a very long time among corporations. Some small businesses will do it as well, but it can be very, very powerful. Number one, I'm retaining my top talent and I'm rewarding them on the back end, which is really nice. Number two, I do have key man insurance on the executives that I place these policies on. But then number three, I get the death benefit at the end of the road anyway. Now, it could be something like 40 or 50 years down the road because the death benefit is being paid out after the retirement benefit is paid out and the individual is passing. But still, I get the money back, income tax-free, when I've had the ability to use that cash value all the way through. We've got some other videos that go through specific case studies of how corporations use this, but I hope that was helpful, both how small businesses and corporations use cash value life insurance. Let us know if you have any questions at all. Please feel free to leave any comments below. We do appreciate it. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.